Hey, what's up guys, it's Jonathan here, back with another public stock portfolio update. So as usual, we'll do a quick recap on some of the moves that we made in the portfolio this week. Then we'll do a quick recap of how the portfolio is doing overall. We'll talk about some important news events that happened this week and some of the things I'll be watching for next week. So with all that said, if this video provides you any value, please consider hitting the like button. It greatly helps out the channel and helps push this video out to as many people as possible. Let's get right into it. As usual, we made our $10 deposit this week. And as a reminder, we have been building up some cash in this portfolio. So we did have some buying power to make some purchases. And we made quite a few. So on Monday, we bought some Tesla. We bought about $15 worth of Tesla at $765 a share. Given that Tesla is now in the low 900s, this seemed to be a pretty good decision to buy on Monday. And personally, I think that if you're able to buy Tesla under 800, it's a really good deal in the long run. On Monday, we also bought some Nvidia as well. We bought about $10 worth of Nvidia at $213.70 a share. And just like Tesla, Nvidia did go on a run as well later on in the week. So that turned out to be a pretty good buy as well. And then on Tuesday, we did some more buying and we bought some trade desks. We bought about $4 worth of trade desk at $54.04 a share. Even though my ad thesis that I had at the beginning of the year that advertisers would do very well as supply chains start to clear up, is starting to fall apart and it's starting to look like more of a 2023 play. I think Trade Desk is still a very good growth play. And I think the fact that they're not only a growth play, but they're also a profitable company as well, really puts them in the driver's seat to do well in this kind of market. And given that I was able to buy Trade Desk at March 2021 pricing, is pretty good in my opinion. So on Friday, we also bought some Disney. We bought about $6 worth of Disney at $139.71. And if you recall, back in January, I actually sold all of my Disney position at $141 a share. So I was able to lower my cost basis, but it wasn't really by a lot. I think that's like maybe a little over 1%. And really, I should have gotten back in on Monday or Tuesday before the market started rallying. I would have probably gotten a much better deal, but oh well. You can't go back and change the past. And also, Disney is a really good company to hold for the long term. For me, I just wanted to take the cash out of Disney and go use it to buy something else. But I decided to get back in, given that a lot of the negative catalysts that we've seen in the market essentially gone. And also on Friday, we did add some more to Trade Desk as well. We bought about $3 worth of Trade Desk at $67.98 a share. And this was really just a purchase to add to that position even more. I kind of wish that I added to that position on Monday or Tuesday, but by Friday, hindsight was 2020 at that point. So now let's go into the iPad and let's do a quick recap of how the portfolio is doing overall. So currently the portfolio sits at $249.45, and we've almost hit the $250,000 mark on this portfolio. And the portfolio moved up 12% during the week, or about $27. So it had a pretty good week. And for the overall, we're still down about almost 12%, or about $33.56. So even though we did have this rally at the end of the week this week in the market, it still wasn't enough to push the entire portfolio positive for its all-time performance. And right now we have about $30 worth of buying power on the sidelines to buy just in case there is another dip. So our first position in this portfolio is Tesla. Our Tesla position is currently up 8%. It makes up a little over 25% of the portfolio. Next position we have here is Enphase. Our Enphase position is currently up almost 14%. It makes up about 17% of the portfolio. As we started to see high energy prices, a lot of people are looking to turn to solar for savings. And this is probably some of the reason why we are seeing really good performance in Tesla and Enphase. Next position we have here is Nvidia. Our Nvidia position is currently up almost 11% and makes up about 13% of the portfolio. When it comes to all three of these positions, Tesla, Enphase, and Nvidia, these are companies that if I was going to DCA into positions, these are the three positions for me personally that I would just consistently keep dollar cost averaging into. Thus is my take, not financial advice. Next position we have is Etsy. Our Etsy position is currently down 20%. And makes up 8% of the portfolio. Even though we are starting to see the market move up overall, I think Etsy is lagging a bit because there are some concerns that even though we do have very strong consumers right now, that in the future, this consumer will become weaker as inflation grows more and more, and as the Federal Reserve starts to try to cool down the economy per se. One thing you gotta remember about the stock market is that it's always looking anywhere from 6 to 18 months out ahead. If there's concerns about a company's future, you usually see that concern reflected in their stock price. And I think that's why we're seeing Etsy not really take off with the rest of the market. Next position we have here is Google. Our Google position is currently down about 5%. I will say we do have a pretty high cost basis on Google at $2,800. Personally, I'd like to see that cost basis go down some more, so don't be surprised if I do start adding to Google more in the near future, especially if you get in the $2,500, $2,600 range. Next position we have here is Trade Desk. Our Trade Desk position is currently up 2% and makes up a little under 5% of the portfolio. Like I said, Trade Desk, I really like this position. It is a position I do want to grow some more. It has taken off pretty significantly to a point where I'm not really excited on adding to it, but it is one that I'm definitely watching out for if we do get some pain in the near future. Next position we have is Amazon. Amazon's kind of the same boat as Etsy. There's some concerns of a weaker consumer. The thing about Amazon is they have some other services like AWS that aren't so consumer centric. So I think that that's what's kind of saving them compared to some of the pain we've seen with Etsy, other than the fact that they are like one of the biggest market cap companies in the market. Our Etsy position is currently down 4% and makes up 3.5% of the portfolio. This is a company I am willing to add to if we start to see more pain and we start to see it dive below that $3,000 mark. Next position we have is Cloudflare. Our Cloudflare position is currently down about 10.5% and makes up about 2.5% of the portfolio. With Cloudflare, they are a software company. They're not very profitable. They are quite pricey at the valuation that they're trading at. So this is one that I'm personally still kind of holding off on buying until we start to see a market that's a little bit more enthusiastic on taking risks. Next position we have here is Disney. Our Disney position is basically flat. I believe we purchased it Friday morning at the earlier hours of the market. So there isn't really much movement. It's up about a little under 0.5%. It makes up about 2.5% of the portfolio. Next position we have is Matterport. Matterport's kind of in the same boat as Cloudflare. It's just not as expensive. That position is currently down almost 50%. It makes up about 2% of the portfolio. This is one that I am considering to add. I think what's their price? They're at $8. I don't think $8 is a bad price to pay for Matterport, but I think that you really have to be in it for the long haul. I don't think that a company like this is going to go to their all-time highs anytime soon. Our next position here is SoFi. SoFi position is currently down over 26% and makes up about 1.5% of the portfolio. SoFi, another small cap like Matterport, it's currently at around $10. I don't think that's necessarily a bad price to pay for SoFi, but I think as we start to see interest rates start to move up, it will negatively affect companies that lend money, kind of like SoFi does. Even though the market might be more open to risk, there also is a headwind that lending companies do have during a Fed hike cycle. Next position we have is Palantir. Palantir, I would almost put in the same exact boat as Cloudflare. Currently, in our position, is down about 43% and makes up a little over 1% of the portfolio. On Monday, the U.S. government got wind that Russia reached out to China requesting military aid in terms of military equipment. And this is mostly due to a lot of the sanctions that have been put on Russia. It hasn't made it very easy for them to receive military equipment. If China was to aid Russia, this would undermine a lot of those sanctions that were put in place. And in response to this news, on Tuesday, the Chinese government did state that they do consider themselves to be a neutral party in this matter, that they will pay if any sanctions are placed on China. On Friday, the US President Joe Biden was scheduled to talk to the Chinese president about this particular matter. And during the call, the Chinese president stated that his country didn't want to have any part of this war, according to Jen Psaki, who's the White House press secretary. Biden did threaten the Chinese president with possible sanctions if they were to aid Russia by providing military equipment. From the Chinese account of the conversation, the president of China said that the sanctions on Russia from the US, EU, and etc. have the possibility of affecting the economies of countries that are nearby to Russia, including China as well, and that these sanctions cause unnecessary suffering to the citizens of these countries. Something that I think is good to mention is that the Chinese economy is in a much different position from the US. While currently in the US economy, we have a very strong consumer who is spending a lot of money out there, China's economy is actually at a point of a recession, mostly due to Evergrande fallout. That has put the Chinese consumer into more of a fear mentality. And one thing about Asian culture that's a lot different from culture in the West is that they're not as consumer centric. So they are naturally already savers. So by them now having to deal with the loss of wealth that they've had to deal with the real estate crash in China, they feel less wealthy, which means that they're a lot less likely to spend money compared to the US consumer that feels very strong right now. So in my opinion, I think that if China was to place sanctions on US, it would probably hurt the US less than if the US was to place sanctions on China. Let me know in the comments what you guys think. So on Tuesday and Wednesday, the FOMC voted for a 0.25% increase to the federal funds rate, and this officially begins a process of takeoff. In the Fed's summary of economic projections, they stated that they plan on doing a 0.25% increase in the federal funds rate each of the remaining 6 meetings that they have this year, for a total of 7 rate increases in 2022. They've also reduced their GDP projections over 30% from what they expected in their last summary of economic projections that they released in December. And this is mostly due to the conflict that's going on in Ukraine. Overall, this is what the market did expect. It did expect a quarter rate hike. It did expect that the Fed was going to slowly raise rates for the rest of the year. The market also did expect the Fed to adjust their GDP estimates as well. In my opinion, I think this is why on Wednesday we saw the market run all the way until the end of the week. So one thing I should add is that Jerome Powell did state during the FOMC press conference, a 0.25% rate hike at one of the next FOMC meetings this year is not necessarily off the table if we start to see inflation become more persistent in our economy. So that's something to keep in mind. Most likely, if we were to see this, it probably wouldn't happen until sometime after the summer, maybe October, November timeframe. But it's just something to keep in mind if you are investing in the markets. So for this next week, I'm really going to look out for any red days. I think that because we've seen such a strong run the past about 2.5 days that the market has been open, I think that we are bound to see a red day. And I think in that position, I will be loading up some more. So if you are interested in seeing what I buy and when I buy it, I have a link down in the description where if you sign up using that link, you get a free stock worth up to $70, and you could follow me and see everything that I'm doing in the markets. So that's all I got for you guys this week. Thank you so much for watching. If you enjoyed this video and this video provided you value, please consider hitting the subscribe button and notification bell so you get notified anytime I post a new video. Also, let me know what you guys think about this market in the comment sections down below. I'd love to hear from you guys. Check me out on all my social medias. I try to post there as often as possible. And thank you so much for watching. I'll see you in the next video.